You see it all the time, right? Headlines screaming about companies or even whole industries posting these absolutely astronomical revenue figures, billions, sometimes trillions of dollars. It sounds incredible. But what if a huge chunk of that money isn't really real? What if it's all just a statistical mirage?
Okay, just look at this number. That's over 31 trillion euros. Yeah, you heard me right, trillion with a T. This is the annual revenue that the wholesale trade sector in the Netherlands reports. A number so huge, it feels like it has to be the bedrock of their entire economy.
But here's the big question, the one we need to ask. How much of that colossal number is actual brand new value being created, and how much of it is just the same money being counted over and over and over again? The answer? Well, it's going to change how you look at headlines forever.
So here's how we're going to crack this thing open. First, we'll expose what the revenue mirage really is. Then, we'll get into the absolute key difference between gross output and value added. After that, we'll put a few major sectors under the microscope, see how this creates a productivity illusion, and finally, we'll see what a much clearer, more honest picture of the economy actually looks like.
All right, so what is this revenue mirage? Well, think of it as an illusion of economic importance that gets created when we just stare at that top-line revenue number. The problem is, that number gets massively inflated by stuff like double counting. Basically, the same dollar gets counted multiple times as it moves from one company to the next.
Now, if you want to see through this mirage, you absolutely have to understand the difference between two key ideas: gross output and value added. Honestly, this one distinction is the secret decoder ring for separating financial churn from the real creation of wealth. It's pretty simple when you break it down. On the left, you've got gross output. You can just think of this as revenue. It tallies up every single sale at every single stage of production. But on the right, you have value added. Now this is the smart metric. It only counts the new value that's created at each step, after you subtract the cost of whatever went into it. This, value added, is what actually gets counted in a country's GDP. Let me give you a super simple example. A flour mill sells its flour to a bakery for $1,000. The bakery then uses that flour to make bread, which it sells for $3,000. Now, the gross output, the total revenue, is $4,000. We just added the $1,000 and the $3,000 together. But the actual value added to the economy, that's only $3,000. Why? Because that initial $1,000 for the flour got counted twice in the revenue number. That, right there, is double counting in a nutshell.
And hey, don't just take my word for it. This comes straight from the U.S. Bureau of Economic Analysis. You know, the folks who actually calculate GDP. They put out this warning explicitly, saying that if you just add up gross output, you're going to get a misleading number precisely because of all that double counting.
Okay, theory time is over. Let's see how this actually plays out in the real world. We're going to take this new lens of ours and look at three major sectors to see just how massive the gap between revenue and real value can get.
First up, let's talk about real estate. We see these huge transaction numbers all the time. But how much of that is real economic value versus just, money changing hands?
So for the Dutch real estate sector, a full 30%, almost a third, of all their reported revenue is just what they call pass-through costs. It's just money that comes in and goes right back out to pay for materials and services. Only the other 70% is gross value added, the stuff that actually becomes wages, profits, and taxes.
Okay, next, let's circle back to that industry with the mind-blowing 31 trillion euro revenue figure: wholesale trade. This is a classic high-volume, super thin margin business, and boy do the numbers show it.
And here it is. This is the real stunner. Of all that revenue, all those trillions of euros, only 19% represents the sector's actual profit, what economists call the gross operating surplus. The other 81% is basically just the cost of the products they're selling or money going to pay employees. That 31 trillion euro figure is starting to look a whole lot less impressive now, isn't it?
And for our final case study, we have finance and insurance. This is an area where the gap between revenue and value can become absolutely extreme. And that's because you have things like circular investments and high-frequency trading that can generate unbelievable revenue figures just by shuffling the same assets around at high speed.
Check out this data from Switzerland. It shows that the average insurance worker is 2.6 times more productive than the average worker in the country. But here's the catch. That's measured using value added.
If we were to measure their productivity by looking at revenue per worker, the number would be astronomically bigger and totally misleading because it would include all that pass-through money from premiums and investments.
So why does any of this really matter? Well, it matters because when we confuse revenue with value, we create this powerful illusion about where our economic growth is really coming from. It completely distorts our understanding of productivity and what makes an economy tick.
This confusion really boils down to three big misinterpretations. First, there's the margin illusion, where we look at revenue and think a sector is way more profitable than it is. Second, we mistake circularity for growth. We see all this money churning around and think the economy is expanding when it's not. And third, you get productivity mismeasurement, just like we saw with the Swiss insurance example.
A perfect, almost absurd example of this circularity is something called the repo market. A bank can sell a bond for, say, $100 million and just agree to buy it back the very next day. That $100 million transaction can get recorded as revenue by both banks. You do that every day and you can generate billions in revenue on paper without creating much of anything new.
So after peeling back all these layers of financial noise, what's the big takeaway? How do we actually get a clearer, more honest look at the economy?
This table really puts it all together and reveals the mirage in the numbers. Look at it. For real estate, 30% of revenue is just pass-through costs. For wholesale, profits are a tiny 19% slice of that massive revenue pie. And for finance, even when you measure it the right way, with value added, its high productivity is still just a shadow of the gross financial flows.
The lesson here is actually pretty simple, but it's incredibly powerful. If you want to understand the true economic footprint of a company or an entire industry, you have to ignore the headline revenue number. The metric you need to hunt for is value added, or GVA. That's the number that tells you how much new wealth is actually being created.
So the next time you see a headline flashing some multi-billion-dollar revenue figure, you'll know to ask the right question. You'll know how to spot the revenue mirage. And it really makes you wonder, doesn't it? What other huge economic illusions are out there, just hiding in plain sight?